Welcome to the Inside Technician, and today I'd like to talk a little bit about the relationship between the standard money flow indicator and Fibonacci retracement levels, and how, when they're both applied correctly, can identify high probability market turning points. In this case, a market correction to the downside. Let's reference 1/19/2010 right here at this level, and again February 8th, 2010 here. Now, after the market had established this bottom, I immediately employed Fibonacci, which I'll do right here in real time, to these two exact data points. Now, it's important to remember that after the market had run up, it crossed above an actual 100% retracement and continued to trend upward all the way up and until a 161.8% retracement level. Now, that in isolation signals that there's a high possibility for a correction to the downside. However, when we look at the standard money flow indicator, we have a strong and negative divergence signaling high probabilities, again, of a market correction to the downside. This indicates to a technician that these are inflated highs, and here, the smart money, the insiders, the institutions, the people who actually move stock prices, are on the sidelines being flat. Sure enough, the next few days went by, prices corrected here, and that was about your last chance to go flat as the money flow indicator continued in a negative direction. And sure enough, one of the biggest sell-offs in market history here, traveling all the way down on the low for the day at a zero retracement. Incredible. So we know, as people who employ technical analysis every day to trade and analyzing the markets, first and foremostly, that there are times to be in the market and times to be out, and most importantly, although history doesn't repeat itself 100%, there are similarities. So with that in mind, let's move forward in time, and let's go all the way to these two data points right here at 11/30/2010 and 2/18/2011. Now I'll have to go ahead and cut the original Fibonacci that was laid out to present how we go ahead and lay out brand new levels for a brand new chart. Here we are again, connecting these two data points here this time at this low at 11:30 and here at 2/18. At this point, with again the money flow standard indicator being on a divergence, I felt for sure that we would have a market correction, not as severe as the previous. However, there would be. And sure enough, as we move forward in time, what happened is that the markets did correct. And right here, it found 61.8% retracement. And subsequently, prices have moved up again at about the zero level right here. Now, we've just seen two different examples, not exactly the same, but very similar in nature, of how we can use two time-tested techniques to identify high probability market turning points. And this is what I wanted you to be able to learn today. Thank you for being with me.